Assume you've been paying your life insurance premium for 30 years, never missed a single due date, felt like most responsible adult in the family. One fine day the policy ends, you're still alive. Congratulations. You log in expecting some magic and the insurer basically says, congrats, nothing for you. And you're like, what? Hello folks, I'm Shashank, you're watching Ditto Insurance, and in today's video we're going to talk about what happens if you outlive your life insurance policy. Do you get anything back? Can you extend it? Should you even extend it? And how do you plan this so you don't feel cheated at the end? By the way, if you're already confused about what kind of life cover to take or how long you should stay covered for, you can always book a free call with Ditto's advisors for a spam-free experience. Our services are completely free. Book a call with the link in the description. Okay, now let's start with a simple clarification. Life insurance is not a single product. In India, what happens when you outlive the policy depends entirely on what product you've bought. If you bought a pure term plan, in most cases there is no payout when you survive the term. The contract is clear. If you die during the term, your nominee gets the money. If you don't, the policy ends quietly. If you bought a term plan with return of premium, then surviving the term insurance means you get back the premiums that you paid, usually without any real growth and often after deducting rider charges. If you bought an endowment or money back policy, then surviving till maturity means you get the promised maturity amount plus bonus if it's a participating plan. If you bought a ULIP, outliving the term just means you get whatever the fund value is on maturity. With pension or annuity policies, cultivating the accumulation phase means you now have to buy an annuity or use the accumulated amount to generate a regular income. And whole life covers can go all the way to 99 or 100 or pay as per their rules. But for this video, let's stick to term insurance because that's where the confusion and the disappointment is usually the highest. People buy term, forget what they signed up for, and they feel cheated when nothing comes back at the end. Now, to make sense of this, you need to understand one concept clearly: maturity age. Every life insurance product has an entry age and a maturity age. Entry age is the age at which you can start the policy. For normal term plans, that's usually around 18 to 60 or 65. Maturity age is the age at which coverage stops. For most retail term plans in India, the maximum maturity age is somewhere between 75 to 85. Some products, especially whole life or extended term variants, may go closer to 99 or even 100. So if you're 30 and you choose a 40-year term, you're covered till 70 years. If you're 50 and choose a 20-year term, same story, covered till 70. Now once that age is hit, the contract ends there. Now what happens if you are alive when that end date shows up? In a plain vanilla term plan, the answer is brutally simple: nothing. No maturity benefit, no refund, no bonus. The policy just stops. And this is not a bug. This is exactly how term insurance is meant to work. It's not a savings plan, it's a risk cover. You were paying to make sure that if something happened to you during your highest responsibility years, your family would get a large lump sum. Now, if nothing happened, then good. It did its job quietly in the background. So what are your options if your term plan is expiring and you're still alive, but you still feel like you need a little protection? Now, option one is to let it expire and do nothing. This is actually the ideal scenario if you've planned your life decently well. By the time your term plan is ending, your kids should be independent, your major loans like home or education should be done, your spouse should either be financially secure or backed by a retirement corpus, and your net worth should be enough that your death doesn't financially break anyone. In that case, why would you need an extra insurance payout? Think about it. The point of term insurance is to replace your income when others depend on it. If nobody really depends on your income now, it's okay to let the policy die. You don't lose anything. The plan did the job for decades by standing guard. The second option is renewing or extending your coverage if your plan actually allows it. Now, this is where reality in India is a bit harsh. Renewable term is common in some markets abroad, but in India, most retail term plans do not offer a simple just extend it for 10 more years option. You do have some exceptions. There are group and government schemes and certain LIC and ICICI group covers that are structured as yearly renewable term contracts, and there are a few modern retail term plans like HDFC Life Click to Protect Supreme that allow you to extend your life cover beyond the original maturity in some variants. But even when this feature exists, it comes with strings attached. You will face high premiums because you're much older now. The insurer may ask for fresh medical tests, underwriting will be super strict, and if you're not in the best shape, well, forget the policy. And in some cases, the insurer can legitimately say no, again, because if your health profile has changed drastically. So renewable doesn't mean guaranteed forever. It just means you can try to extend within certain conditions. Now, there's a third option, and that's buying a fresh term plan at that later age. You're 60, your plan is ending at 70, you feel you still have dependents or liabilities that stretch beyond that, so you try to buy a new plan. Technically, you are allowed to, as long as you are within the entry age limit for that product, but there are three realities here. One, premiums go up sharply as age increases. For a 1 crore plan till 70, a 30-year-old might pay something like 13,000 a year, a 40-year-old might pay around 23,000, 50-year-old could be looking at around 46,000, and a 60-year-old could be paying close to a lakh per year. Two, you will have to go through fresh medical underwriting. If your health has deteriorated, diabetes, BP, heart issues, obesity, whatever, the insurer can levy loadings of 25 to 100% or even reject the application. Three, many term plans stop accepting new customers after age 60 or 65. If you cross that age, you may not be able to buy it as a new retail term plan at all. Option 4 is conversion, if your plan comes with convertible feature. Now, what this means is that before your term policy ends, you can convert it to another kind of life insurance product, maybe an endowment, maybe a ULIP, without going through fresh medicals. The idea is that you swap a pure risk cover for policy that has some savings or investment component and continue beyond your original term. The catch is, this feature is quite rare in Indian retail term plans. One example is Kotak's term plan that allows conversion to other Kotak products except term, as long as there are at least 5 years left in the term. But even then, understand what's really happening. Your premium will increase because you're now buying a savings product and you're not extending term insurance so much as switching to a different category altogether. Now, here's Ditto's view on all of this. See, life insurance is not supposed to be with you till your last breath in most cases. It is supposed to be with you till your financial dependents need you. That's usually your working years plus a little buffer. For many people, that is around 60 to 65 in India. For those with late loans, late parenting, or special need dependents, that might stretch to 70 or 75. Buying cover till 99 just to get something back or to ensure that I'm covered for life usually ends up being expensive and unnecessary. If you outlive your term plan and you are financially independent, well, that's a win. Your children are settled, your spouse is not financially vulnerable, your debts are under control, and your retirement corpus can handle your living expenses. Well, in that scenario, the fact that the insurer doesn't pay you anything is not a failure of the product. It's a sign that your planning actually worked. The only time you need to worry is if your term plan is ending and you still have big financial responsibilities, a dependent spouse, kids still in college, significant loans, or a dependent parent who relies solely on your income. So now if you're staring at that situation and unsure what to do, renew if possible, buy a new plan or change the product. This is exactly the kind of nuance that we deal with every day. You can book a free call with Ditto's advisors for a spam-free experience. Our services are completely free. Book a call with the link in the description and we'll help you figure out whether you even need a fresh policy or not. Now, there's another fear people have. If I don't take term till 99, what if I die at 83 and there's no payout? The honest answer is that's fine if by 83 nobody depends on your income. Yes, it's emotionally comforting to think someone will get money when you die, but insurance is not meant to be a guaranteed inheritance generator. That's what investments, property, and other assets are for. Insurance is meant to protect your family from the financial shock of losing your income too early. This is why when we guide people at Ditto, we usually recommend picking a tenure that matches your goal timeline and not your lifespan. For most people, that's still retirement or slightly beyond. If you do very well financially and achieve your goals early, you can stop this policy voluntarily before maturity. At this point, the premium becomes a small sunk cost compared to the peace of mind it gave you. There are some extended coverage options in the market today. Plans like HDFC Life Click to Protect Supreme, Tata AI Sampurna Raksha Promise, or ICICI Prudential iProtect Smart Plus. They offer variants that go well beyond 75 or 80. These can be useful for very specific cases when someone genuinely expects liabilities or dependents to stretch much longer. But even then, the decision should be driven by math and responsibilities, not fear and not FOMO. Alright folks, that was it from me. If you like this video, then please drop a like, comment if you have any doubts, and don't forget to subscribe to Ditto Insurance. If you have any form of life insurance product and are not sure if it's the right one for you, then you can always get a free consult from one of our RDI certified advisors. It's completely free. The link is in the description. Thanks for watching folks. I will see you in the next one. Until then, happy insurance hunting.